Welcome to my Masterclass. I'm excited to enlighten you today. It's just time to say goodbye to the worn-out financial advice that has you on a financial roller coaster. So I'm going to give you a simple, clear plan to grow your money safely, protect you against the ravages of unknown future tax liabilities, reduce or eliminate the amount of interest you pay to banks and credit card companies, avoid paying enormous fees that you're currently paying on your investments that are eating up your earnings. Protect yourself from healthcare emergencies that can ruin you financially, and a way you can have a guaranteed income in retirement. And I'll show you how these strategies will beat the pants off your 401k. You will learn how to get income in retirement you can never outlive, tax-free growth on your retirement savings, tax-free income during retirement, protection from stock market downturns, market-like returns, and easy penalty-free access to your money. I'll also introduce you to an amazing retirement plan where a lender will actually match your 5 annual contributions 3-to-1. So just like your employer will match your 401k investment, a bank will match your investment times 3. So be sure to go through the entire course because I've saved the best for last. 81% of Americans don't know how much money they'll need to fund their retirement. So if you stay with me to the very end, you'll receive an offer to apply for a free retirement income analysis where I will show you exactly how much annual income your current retirement plans will produce and how long it will last, based on the income you'll be requiring during retirement. If there are any gaps, we'll talk about how to fill those gaps so you can rest assured you are on track. Retirement should be a mirror of a life well lived. It should be a time when people get to enjoy their family, pursue their hobbies, and travel. But unfortunately for too many of us, retirement is a time of worry, fear, and anxiety. Do you know that the number one response of people surveyed say they fear running out of money during retirement more than they fear death? And 52% of working Americans will be unable to maintain their standard of living in retirement. I don't want you to be a statistic. So let me start by just going over a few issues affecting your retirement. And I'll start with stock market losses.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
Rule number 1, never lose money. Rule number 2, never forget rule number 1. But we all know another market crash is coming, yet we don't take action. Ideally, your investments should never lose money. But history tells us that in any given year, there is about a 30% chance that the S&P will end in the red. And we also know that a market correction happens roughly every 10 years. Your financial advisor will tell you, don't worry, keep investing. If you just hold on, your money will come back. And he tells you that because he makes money on your money, whether you win or lose. I hate to break it to you, but when you lose money in the market, that money is gone and it's not coming back. If you lose 50% of your investment, you actually need to make 100% in order to break even. And in 2008, investors lost up to 40%. The question is, how much more money would you have today if you hadn't lost the initial principal in the first place? And it took 5 years for the market to recover in the last recession, and something like 22 to 25 years in the Great Depression. This is what happens when you know what's going to happen, but you do nothing until you just can't stand it anymore, and you lock in your losses. It's just human behavior. If you're not convinced we're on the verge of another market crash, look at this chart from 1980 to 2020. The blue line is the market, and the blood red is investors with negative credit balances. These are people borrowing money on margin and inflating the market. And what happened each time when that got too extreme? A crash. A crash. And now look where we are today. We have more credit being extended than ever before in history. Not to mention what COVID has done to our economy. Why go through all the stress and anxiety and devastation when there are incredibly effective wealth-building strategies that only the ultra-wealthy use, but the middle class gets brainwashed into following the same status quo with qualified plans like 401ks? Fees. Tony Robbins realized that the 401k plan his company had was loaded with fees, so he took matters into his own hands.
Since the 401k first came into existence in the early 1980s, it's become the retirement plan of choice for all companies, big and small. Today, there's over $3.5 trillion in 401k plans, and really they're the largest profit center, one of them, for major insurance, payroll, and Wall Street firms. So by now, you'd think with decades of compounding, those baby boomers would be financially set. But we all know that's far from the truth. Why? Because there's a hole in your investment bucket and it's draining your financial future. What is it? Well, Vanguard's founder, John Bogle, who's been one of the most respected investment professionals for almost 60 years, calls the problem the tyranny of compounding fees. Your fees are eating you alive. Ironically, according to a recent study by the AARP, 8 out of 10 people don't know the cost of their plan, and 70% of those participants believe they're actually paying no investment costs for the 401k. The startling truth is that you couldn't be further from the truth. 10 to 15 times more can be spent by one person compared to their neighbor right next door for the same fundamental product with no additional value. Now you gotta say, how is that possible? Well, so much of what you pay is buried in the fine print. The language is so confusing, it almost requires a foreign language to understand. Revenue sharing, expense ratios, wrap fees, soft dollar costs, transaction costs, account charges, redemption fees, deferred sales charges. There are more than 17 total fees that can be stacked up, all in that fine print. Consider this. Most plans are constructed by actively managed mutual funds. In other words, these are people, they're funds that are trying to beat the stock market. But in the last 10 years, only 4% of all the 8,500 plus mutual funds have ever been to beat the market. And in any 10-year period, it's a different 4%. That means 96% of them failed. And if you look at the numbers over the last 15 years, it's the same 96%. Different people, same ratio. So think about this. Mutual funds really have an average expense ratio today of 1.5% or higher. Compare that to a plan that was constructed with low-cost index funds that match the market. So they're 96% more effective than virtually all of the mutual funds, but the average expense is 0.14. That's 14 basis points. If you hear those numbers and it's confusing, think of it this way. If you're investing $100 in a fund like that, it costs you 14 cents. On the average fund, it's $1.50. That doesn't sound like that, but it's 1,000% difference in fees, and those fees compound every year as you reinvest. See, ignorance is not bliss, and what you don't know in the financial area will hurt you. A Forbes recent article says that the total cost on average is 3.1%, while some of these funds are as much as 4.6%. So what does it mean to you? How much of an impact do fees really have on your future? People have no sense of the reality. According to Bloomberg, if you have a lifetime of investing, you can say basically goodbye to half of your investment nest egg in fees. John Bogle, the founder of Vanguard, again, is even more direct. He says, imagine that you're in a business where you put up all the money, you take all the risk. If you lose, you lose. But your investment partner, the person just handling the funds for you, gets up to 70% of your profits over the lifetime of your investing. See, minimizing fees could mean the difference between ability to retire or not. It could save you, by minimizing fees, a full decade. You could retire a full decade sooner. I'll give you an example. Take two neighbors. Let's say they both are side by side, live on the same street. One is in an average fund at 3.1% that Forbes talks about, and one is in a low-cost fund, the best possible, 0.414, the 14 basis points. What's the impact? Well, if they invest $5,000 a year, every year, and they get an 8% return over their investment lifetime, one ends up with $1.4 million, the other is $619,000. That's 100% difference.
And you got to wonder, how how many tens or hundreds of thousands of dollars have you lost in fees so far? All right, so the United States government has been campaigning for decades to convince us to defer all of our taxes to retirement. Now, that just doesn't make financial sense. And I'll show you why. And the U.S. is facing the worst economic downturn since the Great Depression. So you have to wonder, how the heck is our government going to pay for all the trillions of dollars in stimulus checks and bailouts, not to mention double-digit unemployment numbers, and the national debt is out of control? How are they going to pay for that? By raising taxes, of course. In 2009, former U.S. Comptroller General David M. Walker wrote a CNN op-ed entitled "Why Your Taxes Could Double." He laid out the case that sooner or later taxes will have to double if our country is going to avoid bankruptcy. And the Congressional Budget Office reported in 2008 that if Social Security, Medicare, and Medicaid go unchanged, the lowest tax bracket would increase 2.5 times. Keep in mind that was 2008 and 2009, before COVID-19 and its effects on our economy. But to put today's tax rates into perspective, the top marginal income tax rate in 1960 was 91%. And it wasn't until the 1980s, after President Reagan took office, that rates came down below 70% for that top tax bracket. It was also during this time that the traditional 401k was first made available, bringing tax deferral to the forefront of personal finance. At the time, with taxes high and debt low, deferral made sense. Retirement is when we need our money the most. But if you have most of your retirement savings in a 401k, 403b, or IRA, you are deferring all your taxes to retirement, and you'll be taxed at a much higher rate. Seriously, whose retirement are you planning? Yours or Uncle Sam's? Think about how that would devastate your retirement if you were planning on deferring all of your taxes to the day you retire, and then finding out you have to pay 2.5 times more than you would have had you just paid while you were working. How would that impact you? So it's no wonder taxes are your single biggest retirement risk. When you think of taxes, ask yourself this question. Would you rather pay taxes on the seed or the harvest? If you were a farmer, would you rather pay taxes on the seed or the harvest? The same can be said for all of us as we plan for retirement. We start with a seed, watch it grow over time, and then we enter retirement with the intent of reaping the bounties of our growth, only to find out that the IRS has a right to a large part of it. With a qualified plan like your IRA or 401k accounts, you are deferring all of your taxes until retirement. On top of paying much higher taxes on that money in retirement, your money will actually be taxed twice when you die. Once on the money left in your account, death tax, and again when your beneficiary receives the leftovers as income, inheritance tax. And then we have 10,000 baby boomers retiring every single day who are taking Social Security and Medicare. Social Security is projected to become insolvent in 2035. Medicare will run out of money in 2026, and Medicaid in 2028. And when Social Security was created in 1935, there were 42 people contributing for every one person drawing benefits. Now there are 3 people for every one, and guess what? When Social Security was created, they set the benefit age at 65. Any guess what the average lifespan was at the time they created Social Security? 62. So basically, they were counting on almost everyone dying before they even got to the age of using Social Security. And now it's transformed into this program that almost everybody uses and lives on for 20 to 30 years. And nobody wants it to go away. People aren't planning for failing physical and mental health in their retirement plans. According to AARP, 2/3 of today's seniors will require long-term care at some point in their lives. The odds of your house burning down in your lifetime is 3%, and that would be a huge loss, but your homeowner's insurance would cover that. The odds of a car accident are 18%, but again, your auto insurance would take care of that. What would happen if you needed full-time care to help you live your life? What would that cost? Well, do you know that the odds of you needing long-term care between now and when you die are 72%? However, less than 30% of Americans have long-term care insurance to protect themselves. So we want to solve all these issues, and you can with the retirement savings options I'm going to cover. Now, the options I will go into are fixed and indexed annuities, indexed universal life insurance contracts, and that really exciting program I talked to you about where a lender will match your 5 annual contributions 3-1. And that program is called Kai-Zen. Now, the reason these products have had a bad reputation, or maybe you even have never heard of them before, is because of bad agents.
Michael, one day all this will be yours.
This?
See this junker? I paid $100 for her. She's got 120,000 miles on her. Transmission shot, bumpers have fallen off. What do I do with her? I sell her. We really should weld these bumpers on, but that takes time, equipment, money. So, we use super glue instead. Go ahead, put it on there.
Won't it fall off?
Definitely.
Isn't that dangerous?
Not to me, okay? Transmission. The sawdust quiets the gears and lets the engine run as sweet as a nut for a couple of miles.
Daddy, that's cheating.
Of course it's cheating. Nobody ever got rich being honest.
So you gotta be careful. I mean, these people are everywhere. You can't tell a book by its cover. Bad agents and financial advisors don't necessarily look that part. All right, so what the heck is indexed universal life insurance? Well, first of all, you'll also hear it referred to as an IUL for short. But to me, an IUL is just magic and outperforms your 401k in so many ways, and I'll show you how. IUL will give you tax-free growth on your retirement savings, tax-free income in retirement, protection from stock market crashes, market-like returns, easy penalty-free access to your retirement savings, and the ability to act as your own financing company for major purchases and investments. Before I start addressing what indexed universal life insurance is, it's important you understand what indexing is, since this is an indexed product. With indexing, you choose an index like the S&P 500. Your money is not invested in the index, but you get the return based on the movement of the index. Your money grows however the index performs, up to a limit or a cap, for example, 12%. Now, if the market grows 15%, your money will only grow up to the 12% cap. But the trade-off is complete downside protection from market losses. So just like you would have a cap, you would also have a floor of 0. So the worst thing that could happen is you get 0 interest in market downturns. In other words, you lose nothing, ever. Would you rather be invested in the red line or the green line? The red line is the market strategy, or the S&P 500, your 401k, 403b, or your IRA. And the green line is the index strategy, where you make market-like returns, but you're protected from stock market downturns. This is a comparison of the market strategy and the indexing strategy. At a 12.5% cap with a $100,000 balance, over the last 20 years, if you would have just gone to sleep and put your money into an S&P 500 index, you'd have $153,000 more in your account with a cap and a floor than you would just writing it out. There are 3 vehicles available to get a tax-free income in retirement: a Roth IRA, municipal bonds, and permanent life insurance. In this case, in the form of fixed or indexed universal life insurance contracts. The differences between the 3 are risk, contribution limits, age restrictions, returns, how your money grows, income, required minimum distributions, or RMDs, fees, funding, access to your money, death benefits, and living benefits. An IUL contract has no risk to stock market downturns because it's an index product with a ceiling and a floor, so 0 risk. No annual contribution limits, no age restrictions, easy and penalty-free access to your money, market-like returns, your money grows tax-free, you get a tax-free retirement income, no required minimum distributions, you get a death benefit and living benefits, and limited fees only if it is structured properly. And by saying that, you really do have to be careful because, first of all, very few agents are trained on how to structure these innovative policies to optimize the growth of your money. Or they do, and they'll actually structure these policies to optimize not your money, but their commission. So be very careful. Now, unlike an annuity, you cannot roll over a 401k or any other qualified money into this account unless you pay the taxes on your qualified funds first. Because this is a life insurance policy, you have access to the death benefit tax-free while you're alive in the event you have a critical or terminal illness or you're diagnosed as chronically ill. You can receive a portion of the death benefit while you were living to pay for long-term care expenses. So you would commit to a monthly or annual premium. And if you want to supercharge your policy, you can contribute a lump sum up front. IULs require between 12 to 15 years to hold a reasonable cash value. You may be asked to complete a health examination as part of the application process with the IUL. One of the key benefits to owning a universal life insurance policy is the ability to access funds from your policy's cash value without having to pay taxes on it. If you have or are thinking about buying an index universal life insurance policy, it's important to understand the different kinds of loans and how they work. So let's get into it. There are 2 different types of universal life insurance loans. There are fixed loans, which are also referred to as standard loans, and participating loans. A fixed loan is the most conservative type of loan. It also has the lowest income potential, and it's used in whole life policies. In the first 10 policy years, a standard loan is available. And after the first 10 years, you are automatically going to be put into a wash loan, or they'll charge you a certain percent on the loan, but they'll credit you that exact same percent on the loan, thus a wash. It is a non-participating loan because your money is no longer participating in the growth, but just earning the declared interest rate. With a fixed loan, when you take a loan, there are 3 different accounts involved. Your life insurance company account, your insurance policy and the accumulation value, and your personal bank account. So money goes directly from the life insurance carrier account straight into your bank account. Then the carrier places a lien, for all intents and purposes, against the life insurance policy to back the loan. Now, with a fixed loan, there is one more account, and that is the fixed rate bucket, we'll call it. They're going to take whatever the value of the loan is out of your policy accumulation value and put it into this fixed rate bucket. And now your money is no longer participating in growth. It is just earning the declared interest rate, which is laid out in your contract. Now, a participating loan is used with Indexed Universal Life. They're the most common loan. You can have a fixed or a variable loan, and the fixed loan is safer than the variable type. Now, with participating loans, you have the same 3 accounts that you do with the fixed loan, but the difference is your money never leaves your policy account. It continues to earn interest. So you earn money on the money you loan yourself. Now, you're charged interest for taking that money out, but the interest you're getting on that money more than offsets the charge. And you'll see that reflected in your cash value. The value of the loan is deducted from your accumulation value, but your accumulation value stays the same. Now, how does it work when you're taking distributions as tax-free retirement income? Unlike traditional loans, an IUL policy loan does not have to be repaid. The death benefit is simply reduced by the amount of the outstanding balance. And you're probably thinking, well, this is just too good to be true. But the death benefit and the related features are the guarantee that is backed by the claims paying ability of the underlying insurance company. All that being said, it's important to note that IUL policy loans and withdrawals will reduce the available cash value and death benefit. And if you withdraw your money as a partial surrender instead of taking a loan, you are taxed and subject to a surrender charge. And if you take that before the age of 59 and a half, you'll have to add a 10% federal tax or early withdrawal penalty on top of that. Also, additional premium payments may be required to keep the policy in force. Let's say you have $100,000 in cash value in your policy, and you decide to take out a $20,000 policy loan to buy a new car. Let's say the insurance company charges you 5% on the loan, and the market went up 10%. That loan didn't cost you anything. You actually made 5% on the money you loaned yourself. So let's compare income from your 401k versus an IUL. Take a 65-year-old whose annual income was $97,000 while he was working, and he wants to maintain that same income in retirement. With a 401k, he has $858,000 in retirement savings. He withdraws $129,340, knowing he'll have to pay $32,335 in taxes on that withdrawal in order to get to his $97,000 income. This poor guy will run out of money in 9 years at the age of 74. The 65-year-old with the IUL has $709,000 in retirement savings. He takes his $97,000 annual income tax-free and has an $864,000 life insurance death benefit. If he dies at age 100, he would have received $3,395,000, and his family receives $3,036,000 in death benefit, both free of income tax. More than 3,000 big banks and 85% of Fortune 500 companies buy cash value life insurance by the hundreds of billions in assets as part of their Tier 1 capital, which is the safest money they have. But it also has to be liquid, give them solid growth, and they're not going to lose it in a market downturn. JCPenney used cash value life insurance during the Depression to keep his company afloat. Ray Kroc used it during the expansion years at McDonald's to cover payroll when sales were low and his franchisee fees weren't covering it. And Walt Disney used it to purchase the land that Disneyland is on today. This is a proven strategy that has only gotten better over the years, and the fees and the costs are so much lower than they used to be. So you don't have to be a millionaire anymore to use it. Now, we're going to get into the guts of the proper way to structure an IUL for maximum cash accumulation. There are two ways you can structure these. The traditional way, which has a really bad reputation because of high fees, high costs, and high commissions. Traditionally, they were sold as a very expensive insurance policy that made agents big commissions. So as you can see, the bulk of your money here goes to insurance costs, and your cash value is minimized. The death benefit is what drives the fees, commissions, and the cost of the policy higher. There are some stark differences between the traditional way and what can actually be done if you know what you're doing. You flip this concept upside down. You maximize the cash value in your IUL and you minimize the insurance cost. Structured this way, it reduces the administrative costs for your insurance because your death benefit is lower. So the commissions paid to an insurance agent are lower. So when you hear Dave Ramsey, Susie Orman, your financial advisor or CPA or brother-in-law saying these policies are expensive and not a good investment, they're talking about the red bucket over there. So let me give you a hypothetical situation of a 45-year-old man putting in $20,000 a year. I'm going to pull back the curtain and show you how the same amount of money going in can have a dramatic difference in your retirement cash flow and the commission your insurance agent would make. If you were to use a typical structure like the red bucket with a level death benefit and no cash optimization, and this 45-year-old man is putting in $20,000 per year for 21 years, at age 65, he's going to have $523,000 of cash value, a $1.5 million death benefit throughout the life of the contract, and the agent who sells that is going to make a $27,000 commission. So the guy's putting in 20, and the agent's making 27. That's a pretty good size commission, right? So this is the way these policies were traditionally structured. Very few agents know how to structure an IUL for maximum cash accumulation. You can use cash maximization and still use a level death benefit, and it improves your cash value significantly. Now get this. You lowered your death benefit by $500,000, and look what that did to your cash value. It increased it by $141,532. Did you put any more money into this? Nope. Same amount of money, different structure. And look at what the agent gave up in order to give you $141,000. That's about $8,000. So doing it this way, it cost the agent $8, but made you $141. Do you think it's right for an agent to cost you $141,000 in order to put another $8,000 in his own pocket? No, and I don't either. It's criminal as far as I'm concerned, and that's why I don't build these policies this way. Now, there's one more thing you can do if you know what you're doing, and that is to use an increasing death benefit. And this is where it gets extremely efficient. You start with the lowest death benefit the IRS will allow, and you step it up each year as your cash value grows. This drops the death benefit another $644,000. So from the first to the third, we dropped $1.1 million off the death benefit, and look what it has done to the agent's commission. It's cut the commission $20,000 overall. Let's see what it does to your cash value. So you've gone from $523,000 to $811,000. That's almost $300,000. And again, did you put any more money into this policy? What's the only difference? Well, it's using somebody who structured it right and knows what they're doing. So to wrap it up, the benefits are undeniable. It is best for people who are 15 to 20 years from retirement. Your money grows tax-free, and it is distributed to you in retirement tax-free. There is zero risk to stock market downturns. There's no age or contribution limits. You have penalty-free access to your money through participating loans, where you can finance your own big-ticket items. You get market-like returns and have a death benefit with living benefits in case you were to have a heart attack, stroke, or, God forbid, something happened to you. But most importantly, an IUL needs to be structured properly, or it will be an expensive life insurance policy with the agent laughing all the way to the bank. I am going to introduce you to a 3-to-1 matching executive retirement solution called Kai-Zen. Kai-Zen is a unique retirement plan that will increase your retirement distributions by 60 to 100% using leverage, where a lender matches your 5 annual contributions 3-to-1 at LIBOR plus 1.75%. This is not a gimmick. It's a legitimate strategy that up until recently has only been available to the ultra wealthy, but now is available to those with an annual income of at least $100,000 who are in good health and no older than 65. So stick with me until the very end, where I'll give you all the information you need to learn more and to apply. Kai-Zen is basically an IUL on steroids. Benefits include 60 to 100% increase in retirement distributions from the 3-to-1 match, market-like returns with zero risk to stock market downturns, tax-deferred growth, tax-free distributions in retirement, tax-free death benefit that can also be accessed while living in the event you have a chronic, critical, terminal illness or you need long-term care. There are no contribution limits, no RMDs, no loan documents, no interest payments, not even a credit check or personal guarantee. And your Kai-Zen account is protected from lawsuits, creditors, and bankruptcy. Almost every study indicates that a large percentage of people, including high-income earners, have not saved enough money to maintain their lifestyle in retirement. And high-income earners need to save even more for retirement over and above what Social Security and qualified plans like 401k or IRA would provide. Kai-Zen is one of the very few strategies that allows participants to use leverage to give them more benefits than they could save by themselves. You know, Americans' greatest financial fears are, number one, financial emergency, not enough savings to retire and outliving their retirement savings, not being able to afford medical expenses, job loss, and death of the primary breadwinner. Financial emergency. Most Americans save in order to have enough money in case something unexpected happens and they need a large sum of cash. And because of this, they avoid investing too much at one time. Kai-Zen is designed to not only make the most of your money, but also protect you with coverage and access to cash in the case of a financial emergency. Insufficient savings. If you retire today, could you live off the money you've saved for 22 years, which is the average length of retirement? Would you be able to maintain your current lifestyle? If you fully fund your 401k with 6% matching funds, do you know that you would actually have a 70% lifestyle drop in retirement if you earn over $250,000? Unless you supplement your planning. And 90% of people earning over $200,000 are under saving for retirement. The average 45-year-old actually needs to save 35% of their income in order to retire comfortably. And contrary to popular belief, spending does not drop in retirement because it's just spent on different things like healthcare. But because Kai-Zen is an IUL, it comes with living benefits. Death of a primary breadwinner. Approximately 70% of U.S. households would have trouble meeting everyday living expenses within just a few months if the primary wage earner were to pass away today. So let me introduce you to Kai-Zen.
When it comes to retirement, executives often think investing in stocks and other investments will provide enough income to maintain their current lifestyle for the average 22-year retirement. But in most cases, this ends up not providing the means to maintain their lifestyle throughout retirement. And when they come to this realization, it's too late to do anything about it. Most highly compensated people don't start saving until their 40s, missing out on years of compounding interest. This result is a significant loss in retirement funds, and in their 40s, most are saving only about 9% of their income. So how much should you be saving if you want to maintain your current lifestyle in retirement? 33% of your income. There's got to be another way to meet retirement goals without having to use a third of your income during your career. Well, there is. You now have a way to maintain your lifestyle during retirement. Introducing Kai-Zen. Kai-Zen is a proactive strategy that gives you access to extra money up front, providing you the potential to earn more for your retirement, protecting your future income without putting a drain on your current way of living. This strategy helps you maintain your current lifestyle in the event of a chronic illness, premature death, or inability to sufficiently save for retirement. Traditional retirement plans are typically insufficient for high-income earners. Kai-Zen is different because it makes use of leverage without the need for participant loans, interest payments, or personal guarantees. One of the greatest advantages of leverage is it provides an opportunity to significantly enhance your ability to save for retirement. Experts agree, when used correctly, leverage is a very powerful retirement tool. Even Forbes says you can leverage your way to a richer retirement. Here's how Kai-Zen uses leverage in a very different way. Your contributions are matched by the lender for the first 5 years. Then, the lender uses that as security for the additional funds for the next 5 years. The contributions are used to fund a cash accumulation life insurance policy. A minimum amount is used to purchase the death benefits, living benefits, while the majority of the cash is used to maximize your potential tax-advantaged growth. What could be better? Kai-Zen also has unique cash accumulation features within the policy. When a major market index like the S&P has growth, it is calculated and credited to you. Once gains are credited, they cannot decline due to market losses. This helps keep your money safe. Would you rather have this in retirement or the potential for 60 to 100% more retirement income with Kai-Zen? Secure your lifestyle with Kai-Zen. More money, more protection, more confidence.
Annuities can be traced back to Roman times and have been available in the United States since 1812. In 1905, Andrew Carnegie founded the Teachers Pension Fund, which in 1918 turned into the Teachers Insurance Annuity Association. But I'm going to be very honest with you, annuities have a really bad rap, and it's because of the reputation of variable annuities, which are risky and expensive. With a variable annuity, your money is in the stock market, and your money is at risk to stock market losses. And they're also just loaded with fees. So this is why you hear people like Susie Orman, Dave Ramsey, Ken Fisher, your financial advisor, your CPA, your brother-in-law say annuities are bad. And the only thing bad about annuities, besides variable annuities, is that bad agents will take advantage of your ignorance by putting you into a variable annuity just to get a bigger commission. So I want to get this out of the way right now because I don't recommend them. I have never sold a variable annuity, and I never will. So if you're interested in a variable annuity, I am not your lady. So moving on, there are 3 types of annuities, but obviously I'll only be addressing fixed and indexed annuities. Fixed annuities pay a fixed interest rate, and indexed annuities pay based on the value of an external index. So an annuity is a contract between the investor, otherwise known as the annuitant, and the insurance company. The funds used to purchase an annuity are called a premium, and those funds can be qualified or non-qualified. The insurance company will take that premium and invest it in safe investments. An annuity offers a moderate interest rate, better than a CD or bonds. And people acquire an annuity because they either want a guaranteed income for life, for a certain period of time, or a specific return on their money. Life insurance is all about risk, and this is the likelihood that an insured event, in this case death, should occur throughout the duration of the policy term. If you want a lifetime income, the payment amount is calculated based on the number of months between your current age and your life expectancy age. So if you are 65 and your life expectancy age is 80, the payment amount is based on 180 months. If you live beyond your life expectancy, the monthly payments continue. So there are 2 ways you can fund an annuity. You can fund it with one single lump sum premium or multiple premiums. An immediate annuity, also referred to as a SPIA, single premium index annuity, differs from a deferred annuity, also referred to as a DIA or deferred indexed annuity, in that they do not have an accumulation period. They're funded with a single lump sum payment rather than a series of premium payments. And the distribution period begins within 1 to 12 months after the purchase. Because the funds in the immediate annuity have not had time to build interest, income payments are lower than a deferred annuity. Also, if you fund this annuity with qualified money, the income you receive from the annuity will be fully taxable as ordinary income. If you fund an annuity with money you've already paid taxes on, you would only pay taxes on the interest you've earned. One risk of immediate annuities is being locked into current interest rates when the current interest rates are unusually low, just like they are today in 2020. Should interest rates rise over the period of time during which the annuity payments are made, those annuity payments will not reflect that rise. Locking in the annuity interest rate is just part of the cost. Now, if you do wait until a later age because you're still working or have other sources of income such as a 401k or Social Security, you don't want to tie up all or even most of your money in an income annuity, because once you convert it to income, it belongs to the insurance company. And keep in mind that annuity income is a fixed income, which means it will lose purchasing power to inflation over time. Investing in an income annuity should be considered as part of an overall strategy that includes growth assets that can help offset inflation throughout your lifetime. So let's say you invest $200,000 in an immediate annuity, and the contract provides for a 5.63% annual income. But after 20 years, the annuity is fully depleted. The insurance company will continue paying you the agreed upon annual income benefit, in this case, $938 a month. Deferred annuities are designed for long-term savings. Unlike an immediate annuity, which starts annual or monthly payments almost immediately, Investors can add funds at any time and delay income from a deferred annuity indefinitely. The income payments from a deferred indexed annuity are typically higher than for an immediate annuity because the funds have had time to accumulate interest. A fixed annuity is also sometimes referred to as a MYGA, multi-year guaranteed annuity. It has a fixed interest rate that is applied to invested funds for multiple years in a row. It's best if your time horizon is 3 years or longer. If less than 3 years, turn to a CD. It's not recommended long-term since interest rates change frequently. Let's talk about index annuities. With an index annuity, you would choose an index like the S&P 500 or a combination. Again, your money is not in the stock market, but it grows however the index performs up to a limit or a cap. At some point, payments will be made to the annuitant, and the amount of those payments depend on how long the insurance company has to invest the premium before income payments begin. Now, a fixed annuity provides the advantage of a guaranteed rate of interest, where an indexed annuity combines a guaranteed minimum return plus the potential of higher earnings if the stock market does well. And at the end of the contract, you can either convert that to a guaranteed income stream for life, or you can take the money out and just walk away with it. Okay, so there are 0 fees with an annuity unless you add a rider. The insurance company pays the agent a variable commission for selling the annuity to you, and they factor that into their contract pricing. Commissions are not deducted from your premium. That's because the insurance company is counting on you leaving your money with them long term. If you don't keep your money with them long term, or if you want access to more than 10% of your money in any given year, you will be charged a surrender charge. And this is just one of the ways they can pay agent commissions without charging you. Surrender charges usually start out at 10% the first year, 9% the second year, and so on. That being said, the surrender charge would be waived under the following circumstances. If you require home health care services as a result of not being able to perform 2 out of 6 activities of daily living, like bathing or dressing, if you're diagnosed with a critical or terminal illness, or if you're confined to a nursing home for at least 60 consecutive days. Now, before we move on, I just want to quickly go over a few popular riders. And these are like add-ons to your policy. But you do pay fees on these riders. With the lifetime income benefit rider, the insurance company guarantees that you will receive regular income payments from the annuity, whether that's monthly, quarterly, or annually. The payments will continue for the rest of your life, even if the actual balance in the annuity is fully depleted. A lifetime income benefit rider can ensure that you never outlive your money. For example, let's say you invest $200,000 in an annuity. The contract provides for a 5% annual income, but after 20 years, the annuity is fully depleted. The insurance company will continue paying you the agreed upon annual income, in this case, $10,000, for the rest of your life. One of the most common disadvantages of annuities is that they are established as living benefit contracts. That is, they provide you with income benefits for the rest of your life, but once you die, there's no insurance benefit for your heirs. And this can be an obvious disadvantage if you purchase an annuity with the intent that it will provide income for you for 20 years, but you die after just 10. The remaining funds in the annuity contract will revert to the insurance company. And since you are only halfway through the expected term of the contract, that's going to be a substantial amount of money. The death benefit rider gives you the ability to provide a death benefit for your heirs in the event of your death, converting the annuity to both a living benefit and a death benefit. A death benefit rider guarantees your heirs will receive at least the amount of the premium you paid for the annuity. For example, if you pay $250,000 to establish the annuity, and as of the date of your death, only half of the premium has been returned to you, your heirs will be entitled to a death benefit of $125,000, and that's tax-free. You can add a long-term care rider to an annuity. The annuity will provide the income specified in the contract, but will also pay a long-term care benefit in case it's necessary. What the long-term care rider does is it adjusts the income payout to help accommodate the cost of long-term care. For example, let's say that the cost of long-term care will be $6,000 a month. If the annuity is scheduled to provide you with a monthly income payment of $3,000, the payment will double to $6,000 per month in the event you have been medically determined to require long-term care. A long-term care rider usually provides a benefit that will be double the normal income payment from the annuity. When you purchase any life insurance product, there is a right to examine or a free look period, which is usually between 10 to 30 days depending on what state you live in. This gives you the right to return your policy for a full refund for any reason. No questions asked. Afterwards, you can cancel the contract at any time, although doing so will likely cause you to incur a surrender charge. Annuities are not FDIC insured, but compared to commercial banks and investment firms, life insurance companies' solvency record has been nearly faultless, even during hard economic times. A large percentage of the life insurance companies that exist today have been around for well over 100 years. In the 2008 financial crisis, only one life insurance company became insolvent, and that was AIG. At the same time, 465 banks failed. And instead of federal regulation, each individual state has an insurance department who's responsible for enforcing strict regulations on life insurance companies. One of the strictest and most important requirements is the dollar-for-dollar reserve requirement, where the company must keep at least $1 in reserve for every $1 in guarantees they've made to contract owners. So an insurance company must have in savings at least as much as it would take for every single contract owner to walk away with the current value of future obligations of those contracts. It's also important to note that banks are not required to keep such reserves. A large bank is required to have only 10% in reserves for every $1 deposited. Would you like to learn about how to become the master of your retirement and get out of the financial rat race so that the financial industry can stop making money off of you? If you have found this masterclass of value, I would love for you to apply to become my client. We will start by completing a retirement income analysis on your current accounts. And if there's a retirement income gap, then we'll talk about how to fill that gap. I'll structure a preliminary annuity or IUL plan properly for maximum wealth accumulation based on the information you provide in the application. And we'll present that to you the day of our appointment. I am a fiduciary, which means, of course, that I put my client's interests above my own. And that's the law, but that's also just who I am. I couldn't live with myself otherwise. The application will ask a number of questions, and your answers will determine if you qualify. And if you do, they'll help me prepare a preliminary annuity or IUL presentation for you, so you can see with your own eyes if this is something you want to move forward with. But know that your information is kept in strict confidence and will never be shared or sold. Thank you for your time today. I look forward to working with you.